Hey guys, it's Barry. Welcome to Legacy Money, the show that shares the truth about money. Today is tax day. April the 18th, had a few days longer than normal. So today is a time that we should pay our taxes. The problem with paying taxes is the government squanders the money. Usually by April the 15th, the government has already spent all of the money that has been collected. So for the rest of the year, they have to borrow money. And when they borrow money, they have to pay interest. And when I say they, you and me.
Let's take a look at some tax facts real quick. In 1913, the federal income tax as we know it begins with the 16th Amendment to the Constitution, giving Congress legal authority to tax our income. Ironically, the same year the Federal Reserve was created. The individual income tax is the single largest tax revenue source for the U.S. government. Individual income taxes and payroll taxes make up the majority of all taxes collected. Tax the rich. High-income taxpayers pay the highest average tax rates already. And half of taxpayers pay 97% of all income taxes. Albert Einstein said the hardest thing in the world to understand is the income tax. The typical American invests in qualified plans. Ironically, a qualified plan must satisfy the Internal Revenue Code by definition. This means that contributions to these plans defer the payment of income taxes. The taxes must be paid in the future. In his best-selling book, Becoming Your Own Banker, Nelson Nash said, when government creates a problem, read onerous taxation, and then turns around and creates an exception of the problem they created, tax-sheltered retirement plans like 401ks and IRAs, aren't you just a little bit suspicious that you're being manipulated?
Hey everyone, so today is April the 18th, 2022. It is tax filing day. It is the deadline to file your taxes. So today is appropriate for this video. It's going to be a quick, short video, and we're going to discuss taxes and other wealth transfers. Really what I want to help you understand is how you can recover some of the money that you might be transferring away. So there's a lot of variables that are involved here, and the first thing I just want to make clear is I'm not an accountant. I'm not your tax advisor, and this is just a strategy, a concept that you might use. For any tax advice, you're going to want to contact your accountant or your tax advisor. So we're going to talk about paying taxes and also the interest and the lost opportunity cost. What I'd like to show you is how to take $1 and have it do the work of $5. Take $1, turn it into $5. So the first way, we're going to buy $1 of protection, life insurance protection for your family, your business, and your debts, whatever you may incur. The second $1 is going to go towards savings. We should be saving money, right? So if you could have that $1 working and saving. The third $1, that is going to be because your money is growing in this savings account. It's going to get a guaranteed return every year, no matter what. And depending on how everything is structured for you, it could be even more. Also, recovery. What we want to do is recover the money that you're now transferring away to others. And then fifth, we're going to show you how to finance your taxes. How you can literally, instead of financing for the IRS, you can finance for your family or business. All right, so like I said, there's a lot of variables involved, and the first one is going to be your age and your withholding status. Your income, how much you make, the tax bracket that you're in, whether or not you're a W-2 or a 1099 type employee, contractor, self-employed, business owner, this is all going to matter. And the date when you start. So the earlier you can start, obviously, the better. What we want to do is to build a pool of capital that we can use as a resource to pay our taxes and other things. Okay. Okay, so we're going to make some assumptions here. We're going to keep things real easy, nice round numbers so you can understand it. So we're going to take someone making $100,000 a year. Some people might make more, some people might make less. It's all relative. Just add some zeros. If it's $10,000 a year, if it's $1 million a year, it's all relative to how this works. But we're going to use $100,000. We're going to assume that they're in a 24% tax bracket, okay? So that's $24,000 of annual tax that would have to be paid. Now, depending on how you pay those taxes, perhaps you get paid monthly, perhaps you're W-2, perhaps you're 1099, you might pay monthly, so that would be $2,000 a month. Or quarterly, if you file quarterly, you send in vouchers. If you're self-employed, that might be $6,000 a quarter. Okay? Now, the second thing that we want to consider is that you're saving, or this person would be saving $10,000 or 10% of their income. So that's about $10,000 a year, $850 a month, or $2,500 quarterly. Now, the third thing that must be considered, since we're talking about wealth transfers, is the lost opportunity cost. So we're going to call that 5%. Basically, we're just going to assume that you could earn 5% on your money elsewhere. So 5% would be about $1,200 annually, $100 a month, or $300 quarterly. All right, let's jump into the details and talk about how everything works. So what we're talking about here is an IBC designed life insurance policy. This is a private contract between you and the life insurance carrier. We like to use mutual life insurance carriers because they are participating dividend paying type policies. So let's assume again that we're saving $10,000 annually. So that would go into the policy. Year one, we would have a cash value of approximately $5,000. Again, it all depends on these variables here and how the policy is designed. So in this case, $5,000. Now, what we're talking about though is that this is going to buy you protection. So year one, this would probably be in the area of $250,000 of death benefit should the worst case scenario happen. All right. Now the good thing about it is this cash value is going to grow every year. So the first year you put in the $10,000, you've got $5,000 available. The second year you put in $10,000, now you have $12,000 available. These numbers will vary depending on, again, the variables and how you treat the contract. The third year, it's going to grow. And by the 10th year, you've got all of the money recovered that you put into this contract, okay? It's going to continue to grow, and again, depending on how it's designed, you may or may not have premiums due, or you may be able to grow the contract even more, okay? But what we're doing is we're building a pool of capital that you can access at any time for any reason. So in this case, we're talking about paying your taxes. So to pay this entire $24,000, you're going to have to capitalize this policy for 3 to 4 years to get that entire amount. That's if you pay annually. But again, if you're paying quarterly or monthly, depending on how you pay your taxes, you can do it that way, okay? So again, if you're a W-2 employee, this is going to vary depending on your withholding, how much they take out of your check, depending on if you get a refund. And if you get a refund, remember you're overpaying your taxes. That's why it's called a refund, because you paid too much. So assuming that that's 5%, okay, that's about $1,200 a year that the IRS is getting free use of your money. You're paying them taxes, but you're also losing what that money could have done for you had it been working for you. Then you take the money out of the policy and pay your taxes, just like you would normally do. The difference is you're just running it through your system, your banking system first. Okay, let's talk about what's really happening here. So, we're saving $10,000 a year, something that we need to do anyway, save money. We want to have this money, though, do more than just be a savings account. It's going to protect Obviously, we're saving, we're storing it safely in a secure place so we have access to it. It's liquid. We want it to grow. It's going to compound and grow every year, compounding growth. But here's what we're going to do. We're going to recover the money because as we pay these taxes, that money is gone forever. But we want this money to stay in our system. So we're going to repay ourselves just like we would repay a bank. We're going to borrow the money every year. And we're going to use what we would normally pay as taxes, prepay taxes, to pay hopefully at the end of the year. Now, again, this is going to vary depending on if you're W-2 or 1099 income. If you're 1099 income, if you're a business owner, you're going to understand because you file your taxes at the end of the year. You may send in quarterly taxes. Either way, what we're trying to do is have that money stay in our system. So here's how that works. We're going to put the $6,000 or the $2,000 or the $24,000. We're going to repay that just like we were paying our taxes back into our IBC system. Now, each year we need to take that money out as well, depending on how you file or pay your taxes, and we want to pay that money back to our taxes. So we're basically reusing our money the same way that the banks do. And our money will grow over time. It's compounding. The difference here is we're not interrupting that compounding growth of our money when we take the money out. So we'll take the money out, we'll pay the taxes. We'll repay the money with the money that we would normally pay the IRS in advance. We're only paying it into our system. Now, when we repay the money, well, how much does that cost? Their interest is charged on the money because we're borrowing the money from the life insurance company. They put a lien on our cash value. That's why we don't interrupt the compounding curve. So the lien is placed on our money, and if we want that money to be available to us again, we'll repay that money. Now, the good thing about it is our death benefit is growing just as our cash value. Now, at the end of 10 years, we've got $100,000 that we can continue to use every year, just depending on our situation. Everybody's situation is different. But what we've done is we've taken our money, we've recycled it, we've reused it, it has continued to grow, and now we're in a better position because after 10 years, we will have taken the $1 that's doing the work of $5, and now we have that money in our system to use however we want. So that's a brief description of how you can use IBC to pay your taxes. Everybody's situation is different, so you definitely want to talk to a practicing IBC practitioner, infinite banking concept, licensed and authorized practitioner. They'll show you exactly how to do this. Thank you for joining me today. I hope you enjoyed this video. Please smash that subscribe button, and if you have any questions, just leave them in the comments section below, and I'll see you in the next video.